Hi, Mr. and Mrs. Hess. It's a pleasure finally getting to sit down and meet with you guys in person, and thank you for making the time to do so. I know everyone has just about had it with doing all of the Zoom calls, and so it's really nice to be able to finally sit down and see you guys face to face. Also, welcome back from Europe. I trust you both managed to have nothing short of a great time. Yeah, yeah, I completely agree. Well, now that you're both fully retired, I have no doubt you have some really exciting travel plans geared up for the future and are looking forward to spending lots of time with the grandkids. Yeah, exactly. That's what it's all about. So I'm glad we're finally able to meet face to face today. I know you both wanted help in developing a more thorough financial plan, along with a few concerns you two shared and wanted me to address. So in front of you is the comprehensive review of your overall financial plan that I've put together based on all of the data that you guys sent over to me, which, by the way, I very much appreciate it. You wouldn't believe how difficult the data collection process can be for some people. So I commend you both on your record keeping and organization. So in this packet, we're going to go through your financial health, risk management and insurance, investments, retirement, tax, and estate planning. Now, I know the packet looks a bit intimidating, and in some parts, it very well might be. But I hope that after we're done going through everything, you both are going to walk away with your questions and concerns answered, as well as feeling a lot more comfortable heading into the future. In our prior discussions, you both kind of worked to prioritize some of the goals you had in mind. One was reducing any estate and gift tax liability and ensure all of your estate planning documents are in order. Two was review your insurance contracts and discuss the implications of purchasing long-term care insurance. Three would be reducing your overall personal income tax. And the last one was based on your risk tolerance levels. You wanted me to recommend a more diversified portfolio that meets your investment needs and expectations. So on page two of the packet, it should say at the top, summary of your financial health. Accompanied with this summary is a statement of financial position, which is just a fancy way of saying your basic balance sheet showing us assets and liabilities. You have a statement of your yearly cash flows, and then we have a ratio analysis we did that is going to just touch on one of the key ratios we typically look at when evaluating a client's balance sheet. So your year-end balance sheet reports a net worth of just about $11.5 million. Together, you have built up a sizable net worth along with substantial annual cash flows that are going to be used in reaching your financial goals for retirement and beyond. So with regards to your annual statement of cash flows, this year you have a net disposable income of $1.284 million. Now, this number is obviously unusually high, and that's mainly stemming from the $1 million down payment received from the sale of the business, and in addition to that, the 10 months of payments made on the installment note that began March 1st of this year. So with that, your total inflow for 2022 is 1.651 million, while your total cash outflows come out to $367,000, leaving us with a net disposable income amount of 1.284 million. Now, looking at next year, instead of the $365,000, which is 10 months of payments, is now actually going to be $438,000, and that captures a full 12 months of payments on the installment note. So with that, your net disposable income is still at $357,000 a year, and that's assuming all of the numbers except for the installment payment remains the same, which they're not going to. For example, John, you mentioned wanting to invest the 25% down payment from the sale as well as future installment payments. Doing so is going to significantly change, for example, that total investment income number, which in turn is going to affect what our final net disposable income number is going to be. Lastly, a quick look at your current ratio, which is just a measure of your liquidity. All that means is, do you have the ability to pay your bills in the near term with your current assets? Typically, the industry benchmark is one. Anything lower than one could potentially indicate liquidity issues and the inability to meet financial obligations in the short term. And the upside to this is that you virtually have no current liabilities. Your primary residence is fully paid off, so there's no payments there. You have the credit card bill for about $11,000, which is going to get paid in full once the bill comes. And then you have the 12 months of mortgage payments for the Vermont house. Those are the only two short-term obligations you have. So in saying that, you have a current ratio of 36. Now, in no way is this an indicator of an unhealthy financial picture. What that really tells me is that your current assets could be utilized in a more efficient manner. Currently you're holding $850,000 in cash and equivalents, not including the income from the sale of the business. Now, although parking your cash in savings accounts and CDs is just about foolproof, you are earning very little in doing so. And it's important we keep somewhere between 3 to 6 months of cash reserves for an emergency fund. And right now you are well above that threshold. And this year in particular, we have the ability to invest and potentially grow some of that excess cash without having to tap into any funds being kept in the event an emergency does happen. So for example, let's say we took $1.7 million out of that 2.2 million, leaving you with $500,000 in the bank. That would cover you for a full year at your current expenses, while also leaving you with enough to cover that $40,000 you needed required for a new car. In addition to that, we still have a bit of cushion in the event something unforeseen happens and a bigger expense needs to be covered. With $1.7 million invested even over 10 years at a fairly conservative 5% annual return, gives us an account value of almost $2.8 million at the end of year 10. If we achieved a 7% annual return, the account value is worth almost $3.4 million at the end of year 10. And given your ability to take on a moderately higher level of risk, I think achieving 5 to 7% is quite reasonable, as the averaged annualized return of the S&P 500 index is around 8% since 1957 through the end of 2021. And obviously, inflation and timing do play an obvious role in those returns. Uh, Mary mentioned the grandkids 529 plans and what implications were of making contributions to those plans, as well as any tax forms, if any, would have to get filed. So the IRS considers 529 plan contributions as a gift for tax purposes. So every year, the IRS publishes its annual exclusion for gifts. Simply put, it's the amount you can gift to someone without triggering any tax implications. So for 2022, the annual exclusion amount is $16,000 per person per gift. So Mary and John, you both could each contribute $16,000 to every grandkid's 529 plan. $32,000 per plan per grandkid. You have 3 grandkids, gives you $96,000 you could contribute evenly between the 3 plans without triggering any taxes owed. Now, if you do exceed that annual gift exclusion of the $16,000 to any one person, you will have to file Form 709, which is the U.S. gift tax return. They're due on April 15th, following the year the gift was made. In the past couple of years, the due dates have varied by a couple days just because of the pandemic and the IRS extended filing dates for certain things. On top of that, that's not, even if you do exceed that gift amount, it's not going to trigger a tax owed, but rather it's just a way for the IRS to keep track of your total lifetime gifts. So they do have what's called the lifetime gift tax exemption. And for 2022, for couples, married couples, it's $24.12 million. And we're going to discuss this a little bit further when we get to the estate planning tab. Moving on to your insurance, firstly, I did want to disclose a conflict of interest that I wanted you to be aware of. One of the agents we sometimes refer clients to for insurance wanted me to recommend their specific insurance products for you to become, if you were to become a client in exchange for a commission. Now, however, we hold what is called a fiduciary duty to clients, meaning we have a legal obligation to always act in the best interest for and of our clients. So I would be going against my own fiduciary duty if I simply recommended insurance products to you, not because they are the most suitable products, but rather because I'd be getting paid on them. So I did just want to make you aware of that. Moving on, currently your primary residence is valued at $900,000. We can deduct the value of the land as it's the structure that's being insured. So fair market value of the land is currently $125,000, leaving us with $775,000. Homeowners policies, typically we want them to cover at least 80% of that amount. So 80% of the $775,000 is going to leave us with $620,000. Your policy right now is for $400,000. So we have our current shortfall of $220,000 that is not insured. Increasing your coverage is without a doubt the recommendation I would go. In doing so, it is going to increase your annual premium, but the deductible on that policy is only $500, which is low. And I would say let's look at offsetting some of our premium costs by increasing your deductible on the policy. For the vacation home, fair market value is $750,000. 200,000 of that is the land, so that leaves us $550,000. 80% of that is going to be 440,000. So your policy right now is covered up to $460,000, but I would say no changes at this current point in time needed, but let's be cognizant of the real estate market and its trend upwards, because if the value of the house is going to continue to increase, we are going to want to look at upping our coverage amounts for it. Two important other elements of homeowners policies. Both of your policies are HO3 policies, and these are going to be the most common type of homeowners that you see. They offer standard protections like liability coverage, property damage, etc. The issue with the HO3 policies is that more times than not, flood damage is excluded from the coverage. So I would say let's take a look at what your policy explicitly states will be covered in the event for something like a flood to occur. If not, let's look at possibly adding an endorsement to your current policy that will provide for additional coverage under this. Also, the liability amounts for each homeowner's policy of 250,000 is definitely too low. Those amounts will not really shield you in the event something major happens and you get sued. I would recommend we look at adding an umbrella policy. Basically, what an umbrella policy does, it's just an added layer of protection that goes beyond what your current limits and coverages provide for. So I would prefer to see at least a $10 million umbrella policy, as that is going to give you a significantly wider net of protection in the event your current policies do max out. Both auto and health insurance policies look good, and the only thing I would recommend we change would be increasing the bodily injury and property damage coverage amounts for the policy for the autos. We can look at upping both the comprehensive and collision deductibles, as both are fairly low right now, and hopefully that we can look at that and see it'll offset some of the higher premium costs from some of the increased coverages we make. For your life insurance policies, John, your universal life has built up a really healthy cash value, $955,000. Mary, yours is at $185,000. Although not an immediate need, I would recommend we could look at possibly increasing the face amounts of each policy and seeing what that will do to the premiums. You do also have the ability to pay the annual premiums for these policies with the cash values. And that would give you an extra $30,000, $35,000 in disposable income every year as well. So I know both of you wanted to discuss long-term care policies. Basically, the long-term care insurance is just going to help you cover the cost of care when you have a chronic medical condition, a disability, or a disorder such as Alzheimer's. A lot of policies will reimburse you for care given in places like your personal residence, a nursing home, or an assisted living facility. The cost right now for long-term care facilities can range anywhere from $5,000 to $10,000 a month, and that really just depends on the type of facility you go to, the amount of care you need, and the type of care that you may receive as well. Projections on a long-term care policy I had found for you guys are it would be the policy would allow for each of you to share the other's policy benefits. The benefits would be paid for 3 years or up to $360,000, whichever comes first. The premiums on that policy would be $6,400 for John and $5,000 for Mary, and that premium is paid on an annual basis. However, the IRS does allow for a deduction from income as a result of purchasing long-term care insurance. So the rule right now is that the premiums for long-term care insurance policies have to be more than 7.5% of your adjusted gross income for that year to qualify for the deduction. Um, I'll take a look at a tax projection for this year to see where we're at, but I think we should be good if we do end up going with the long-term care policy that you will be able to receive the deduction. Uh, Moving on to your investment. So you have two non-qualified accounts, the stock portfolio and the mutual fund portfolio, and you have two qualified accounts, which are John's 401k and Mary's 403b. Basically, the difference between non-qualified and qualified is that non-qualified are typically funded with after-tax dollars, while qualified accounts are typically funded with pre-tax dollars. So first, for the stock portfolio, my recommendation honestly would be to liquidate the entire portfolio and reallocate the proceeds into the mutual fund portfolio. There are only four holdings in the account. Now, while the other three have performed fairly well, Stock A has been obviously a major laggard to the account's overall performance. Your cost basis on the stock portfolio is $960,000, while the fair market value is $940,000. So we do have the ability to take advantage of tax loss harvesting, where we end up with just a $20,000 loss in the account. You are allowed to take a maximum $3,000 allowable loss in the current tax year, which will carry over every year until the loss is wiped out. Now, that $3,000 is the maximum allowable you can take. So, in this instance, it would be year 7, the loss would then be wiped out. In doing that, however, we do want to rebalance the mutual fund accounts asset allocation. So almost 40% of this portfolio is invested into international markets, whereas 11% of the account is invested into growth. I would say that 40% into international is way too high of an exposure, especially when growth has been the best performer in the account, but it has the lowest allocation. So I would really recommend the following asset allocation for that portfolio. I would put it balanced at 35%. I would put growth at 30%, bond at 15, and international at 20. And given your risk tolerance levels, we have the ability to assume a little bit more risk in the form of equities. John, your 401k is invested solely in a large cap blend mutual fund. Typically, these funds follow an index such as the S&P 500. No changes to be made in terms of the allocation. Exposure into both large cap growth and large cap value as well. It offers a high level of diversification without having to make things overcomplicated in terms of selecting individual stocks and rebalancing. So one concern to be aware of, and I would say the same for Mary's account as well, is that expense ratios for some of these mutual funds can be really high and they will impact your overall total return. Mary, your 403b account is invested into the 2025 fund. These are also called target funds. So I typically am weary of these for a few reasons. For one, not all target funds are the same. The allocation for the 2025 fund could greatly vary from what the allocation of the 2026 fund may look like. More times than not, from what I've seen also, is that target funds usually hold a really high international exposure. Some of them I've seen about 50% of the entire fund. Next, target funds are basically just a mutual fund of mutual funds. So majority of the portfolio will consist of other underlying mutual funds. Each of those separate mutual funds could have totally different expense ratios, and depending on how this target fund actually calculates their fees, it could add up to a significant amount in a very short span of time. So if anything, I would rather see you put it into something similar to John's account, just a lower cost, large cap blend fund that tracks the S&P 500 index. Moving on to your retirement planning, the main question we want answered is, are your current assets sufficient enough to cover you through retirement? After conducting a retirement needs analysis, I would say we're very comfortable that your current financial position is meeting your retirement goals. Although you are not concerned about saving for retirement, you have done an incredible job in building up a very comfortable nest egg for retirement. As mentioned earlier, we would like to see some of that excess cash you are holding be invested into more income producing assets. For the 401k and the 403b, you will begin having to take required minimum distributions on these accounts by April 1st following the year you reach age 72. You will end up paying tax on the RMD, which will be taxed at your ordinary income rate. There is another type of qualified accounts called the Roth IRA. It allows you to pay tax up front on contributions in exchange for tax-free withdrawals from the account down the road. Now, RMDs aren't required for Roth IRAs except in certain circumstances, one of them being if somebody inherited a Roth IRA that wasn't a spouse, there's a rule called the 10-year rule that they have to take and empty the Roth account out over within 10 years of the owner's death. You are able to do a Roth IRA conversions. Basically how it works is you take funds from your IRA or the 401k and you transfer them into the Roth. You pay taxes on the full amount that's converted, and this strategy can work great for some people. The only issue that I would have with this specifically for you guys is that you're currently in the highest marginal tax bracket. So the tax bill for us right now, I don't think would make sense for us to do. If down the road we end up finding ourselves in a lower tax bracket, maybe a Roth conversion is something we do explore doing. But for right now, I would hold off on going down that route. For the retirement accounts you do have, I would want to see these rolled over into their own traditional IRA accounts. This does not count as a taxable event as long as the amount distributed to be rolled over is put into an IRA account within 60 days of receiving it. So contributions are allowed for the rollover IRAs, and they're capped at $7,000 for those age 50 or older. People that are 50 and older get an extra $1,000, so it comes out to the $7,000 you're allowed to contribute. However, although you do have the ability to contribute, you're not going to be eligible to receive the deduction when filing your tax return. So for 2022, if your modified adjusted gross income is more than $129,000, you're not going to qualify for any part of that deduction. And also rolling over the accounts will allow for us to have more investment options versus what we typically see from that's offered from plan sponsors. So these are going to be more cost effective for you in the long run, as having access to more funds is going to allow us to kind of pick and choose and be a little bit more picky versus current options in your 401k and 403b, where options are going to be more limited solely within the plan. Moving on to our favorite topic and everyone's favorite topic, taxes. And one of the main concerns that you had with your taxes was the tax treatment for the down payment on the sale of the business, along with the first installment payment. In addition to that, John, you wanted to know what the tax implications were for the sale of the 1918 inverted Jenny stamp that you received from your mother. Lastly, I just wanted to go over our itemized deductions for the 2022 tax year. Attached to the plan you have are the full calculations for the above mentioned scenarios. So if you do have any questions as to how we arrived to some of our numbers, just stop and ask me. For the down payment on the sale of the business, the tax treatment for this is not going to be taxed at your ordinary income levels. Rather, we have what is called recognized short-term and recognized long-term capital gains. An asset is classified short-term if it's sold within 1 year of purchase, and it's taxed at ordinary income levels. Long-term capital gains are assets sold after more than a year of purchase, and they're taxed at a rate of 15%. So for the down payment, this will be taxed at a long-term capital gain. And for 2022, it looks as though the long-term capital gain for the down payment is going to be $731,250, taxed at a rate of 15%. Along with the down payment, you have the first payment on the installment note, and that's taxed as the following. So each installment payment is going to be 36,568. Of that, $10,000 of that first payment was on interest, and with the remaining 26,568 put towards principal. So factoring in your return on basis, $19,428 will be your recognized long-term capital gain for the first installment payment, taxed at that 15% rate. Now, the 1918 inverted Jenny stamp is classified as a collectible for tax purposes, and collectibles held longer than a year are taxed differently than what other assets would be held longer than a year and then sold. So for collectibles, the tax rate is actually 28% rather than that 15% for long-term capital gains. Collectibles held for less than a year would be taxed as ordinary income. So in addition to that, there is what is known as the net investment income tax, which is a 3.8% tax applied to certain investment income for individuals, estate, and trusts that have income above threshold amounts. All in, you could be looking at a 31.8% tax rate when or if you do end up selling the stamp. The 15% commission is also important to mention, as the IRS does allow for us to deduct commissions paid from the total sales price. So adjusted sales price would be the 1.55 million less $232,500 in commission, which leaves an adjusted sales price of 1.317 million. The basis of the stamp will be whatever the fair market value of the gift is on the date it's given. So in this case, your basis is $725,000 for the stamp. For your itemized deductions for 2022, I arrived at 25,500, and this is made up of our charitables at 13,500, our mortgage interest for the Vermont house of 2,000, and the $10,000 SALT deduction. However, your current standard deduction for 2022 is 25,900 plus an additional 1,400 because one of you is at least over the age of 65. So that leaves us at a $27,300 standard deduction we could take. I would recommend the following as a way to increase your charitable deduction so we can end up itemizing for the tax year. The IRS currently allows for 100% deduction on contributions made to charity via cash. So one way we could achieve that would be through your retirement account. So since we have to begin taking the required minimum distributions by April of the year after you turn 72, there is something called a qualified charitable distribution, QRD. Now, this is a tax strategy in which your RMD is donated directly to a charity and it is not taxed at all the way up to $100,000. So normally when you take an RMD, the amount is taxed at your ordinary income rates. By doing the QRD, you would be avoiding the tax that comes with receiving the distribution and rather taking it as a charitable deduction on your tax return. So in doing so, that charitable deduction, when we itemize, is going to be allowed a 100% deduction up to $100,000, which in turn is going to lower our total taxable income amount. Moving on to our last section of estate planning. So for 2022, the combined estate exemption is currently at $24.12 million for married couples filing jointly, as we had mentioned previously. So your estate is not going to exceed the current threshold amount in the event one or both of you pass away tomorrow. However, the exemption amount is set to expire in 2025. So we will want to conduct an estate planning review at the end of every year just to ensure we're in line with the most up-to-date rules and regulations. And the remaining two issues with your estate, I would say, is that assets that would be subject to going through probate due to how they are titled, and then the missing ancillary documents for your estate plan. When it comes to estate planning, the main thing we want to be cognizant of is how each of your assets is titled, as that's not only going to dictate the flow of assets after you pass away, but also dictate what assets will or will not be included in probate. So assets like the vacation home, the bank account with the CDs, the mutual fund portfolio, as well as even the installment receivables, we could look at retitling all of these as joint tenants. And this simply means that when one of you dies, the asset is not going to be subject to the probate process. It will automatically transfer to the surviving spouse. And the primary reason for this is frankly that the probate process, it can be drawn out for weeks, months, years before any heir may receive anything. Also, I do like to tell people is that probate is public knowledge. Once a probate case is opened, anyone can really see the case, whether that's by going online to retrieve copies or physically going to a probate court to request copies. The information's out there. Piggybacking onto that, John, your 401k beneficiary is your estate, and Mary, your 403 beneficiary is your estate. So this means that when you die, these accounts are going to be subject to probate. All of that we can avoid by just renaming the beneficiaries on the accounts. So my recommendation would be John, make Mary the primary beneficiary, and then make Edward and Brent the contingent beneficiaries where the accounts would be split 50-50. Mary, I would recommend the same exact thing, the only difference being John is the primary beneficiary now rather than your own estate. Your wills look fine, and I'm glad that you already have those in place. Per stirpes is just a legal term that means in the event Edward or Brent die before you, their share of the inheritance goes to that of the beneficiary's heirs. So in this case, that would be Jack and Eugene for Edward and Beth for Brent. The last thing is I would highly recommend is getting these remaining ancillary documents that you don't have. These are going to include two power of attorney forms, one to name who you want to make business and or financial decisions, and the other is who you want to make medical and health decisions, both being in the event you become incapacitated or disabled. The next would be the directive to the physician. This is just going to spell out what your wishes are regarding life prolonging treatments and procedures. The last one is going to be the HIPAA authorization. This simply just allows you to name individuals that can have access to your medical information and records. So with that being said, I know it was a lot to go through, but I think we made some really incredible progress today, especially with it being our first face-to-face meeting. And to recap some of the main points we went over and what my recommendations are would be, let's visit with an estate planning attorney as soon as possible to execute the remaining ancillary documents needed, as well as let's begin working towards retitling some of those assets that are not currently titled joint tenants. Two, let's increase the coverage amount for your primary residence. You are underinsured for this property, and your current policy is not going to cover the full amount of liability you may incur if something were to happen tomorrow. Let's look at offsetting the higher premium cost with increasing your current deductible, which is only at $500 for the vacation home. Confirm what your policy explicitly states regarding flood damage. If not covered, we will want to add an endorsement to your policy that will provide for additional coverage. Also, we want to look at getting an umbrella policy for at least $10 million, as that's going to sufficiently protect your current assets in the event your current policies max out. Last, let's finalize getting that long-term care policy in place for the both of you, and I will follow up with you on next steps for this. For your investments, let's liquidate the equity account and move proceeds into the mutual fund portfolio. Rebalance the new account asset allocation as balance 35%, growth at 30, bond at 15, and international at 20. We're going to roll over John's 401k and Mary your 403b, just to traditional IRA accounts. We're going to move Mary's account out of the 2025 fund and put it into a more low-cost index fund that tracks the S&P 500. And lastly, we're just going to develop an asset allocation strategy that maximizes investment returns, minimizes taxes, and is in line with tolerance for investment risk. We will present our investment planning recommendations for the down payment, installment, no payments, and your cash and cash equivalents that are being held at our next meeting. So I really appreciate you guys taking the time to meet with me today, and I think we made some incredible progress, and I'm looking forward with building this relationship and seeing how far it goes. And let's figure out what we can meet next.